Good afternoon, folks. Welcome to the Daily Scan. My name is Dan Bird. Today is Friday, November 8th, end of the week. And what a week it was, huh? We're going to take a look at the market and also what our portfolio looks like so far. So let's jump into it. First, I'd like to take a look at the market bias, and you can see we are continuing to move higher. The acceleration is slowing a little bit, but that's to be expected with such a big move. And we're actually getting back up near the top again. So that's all very good. Let's actually look at the S&P chart. And you can see right here, it broke out of the highs back here and had 1, 2, 3, 4 white candles. The one today, however, if I can zoom in a little bit on this, the one today, you can see it pulled back from its high of the day. So maybe running out of steam a little bit. That's actually would be healthy for that to happen, for it to pull back and even maybe come back down to this, which is now support line, which is at about 58.70. So today it ended at 59.95, and actually the high was above 6,000. So I said earlier in the week that we probably would hit 6,000 this week. We did hit 6,000. That's a natural place for the market to pause. So kind of expect that to happen. Now, next week is options expiration next Friday. And for those that have followed me, and when I talk about max pain, options expiration, it's basically in general, and this doesn't always happen, but in general, it kind of works the opposite of what the market has typically been doing. And you can see clearly for the last week, the market has been screaming higher. So I would not be surprised heading into options expiration next week that the market starts to pull back. And there's probably tons of calls that have been purchased the last few days. So if the market makers just allow the market to fall and pull back, it means that they won't have to fulfill those orders and they'll expire worthless at the end of the week. So that's kind of what I'm expecting, but that doesn't mean it always happens. So just keep it in mind, options expiration next week. Let's take a look at the dashboard. I'll bring this in a little bit. So you can see right here, all of the major indexes were higher. NASDAQ, not much, 0.1% basically. So not too much, but there's the NASDAQ, kind of went sideways today. But the VIX is way down right now. I'm going to look at that in a minute. We'll get a better view. Bonds, 20-year perked up a little bit. So 20-year actually started to move higher. Does that mean it's starting its run? Don't know. I'm still a little concerned with the 10-year pullback a little bit as well, which is actually good, but it's still elevated. However, it's really in the normal phase right now. I wouldn't say it's extremely elevated. It's kind of normal. Commodities all pulled back as well. Gold especially. Gold actually gave a short-term down signal today. So gold pulled back, silver pulled back, all of the commodities started pulling back today. The dollar in particular, where I don't know if I have the dollar on here. Yeah, dollar right here. The dollar actually was stronger today. So it started to head higher. And then crypto, Bitcoin continues its march towards 100,000. We'll see if it can get there, but it's looking pretty good. If we move down to the sectors over here, interestingly, utilities was the #1 sector for the day. However, it didn't do so great for the whole week. I'll show you that in a minute. And real estate, technology was at the bottom, communication services. So these are the aggressive sectors. They actually started, they were taking a pause today. And the industry groups, there's really a mixture of staples, discretionary, industrials, a little bit of mixture of everything. Interestingly, keep this in mind. Remember this defense index, because one of our daily scans today was in this particular industry group. And I'll show you what that looks like. But look at the top 10 list over here. This is pretty amazing, actually. I'm going to zoom in if I can. Try to zoom in on this a little bit. And I'm just going to go down. This is the top 10. Now, this is a list that I put together based on the top 10 that I update every weekend. I have three top 10 lists, and I consolidate. I gather all that information every week. Even the ones that fall out of the top 10, they're still good performers. And this is what I run my scans against. So we'll talk about that when I get to the daily scan portion, but we'll just watch each of these. So this one here, there's a little chart right there. Look at that. Exploded today. You can see it was up 55% on the day. Upstart, we talked about that earlier in the week. Look at that. It's actually on the daily scan list, not of the ones that were purchased, but the watch list. So we didn't get into it, but I'll show you where we could have. Up 46% today, just today. Docs, look at that, way up there, up 34%. Axon, up 28%. APP, AppLovin, up 17% on the day. This one looks beautiful, up 17%. Admo, I've talked about this before, up almost 15%. Sterling Infrastructure, up 11%. Fortinet, up dramatically 10% on the day. And then this one here. So these are the stocks that are in the top 10 list, and these are ones that have consistently ended up in the top 10. So that's what I use to run my scans. So let's see. Let's go back over here. I want to talk about the secular bull market. First, I want to make sure we do the disclaimer that I am not a financial advisor. I cannot give you recommendations on what to buy or sell or when to buy or sell. That is completely up to you. This is done strictly for educational purposes. Each person has to determine their own risk profile and style of trading. So it's up to you to make your own decisions. If you do decide to engage with a financial advisor, I recommend that you go to this site right here and research them to make sure that they are they've got a good track record, and this will allow you to search on that kind of information. This is all on the front page of my website, breakpointtrading.net. Anyone can go here and look at this. There's a free newsletter right there. But I want to really focus down here in the middle of the page. This is so important that I put it right on the front page. So this is the secular bull market. Secular bulls typically last 18 to 20 years. Secular bears typically last roughly around 12 years. You can see the secular bear from 2001 until 2013. It actually bottomed in 2009, but it didn't confirm until it broke above these previous highs in 2013. So if you count 18 years from 2013, you get 2031. If you count 20 years from 2009, you get 2029. So this secular bull should continue for probably 5 or 6 more years. And for that reason, any pullback that we have, any cyclical bear market like we had here, let me turn my cursor on, like we had right here, never went below the 200-week moving average. Back here is the 1987 crash in the previous secular bull, just a blip. Here's COVID, just a blip on the screen. So we are in a secular bull, and don't ever forget that. Keep that always in mind. And you'll know that we're no longer in a secular bull whenever we start to break down any of these levels. So we came close 4 times since 2010, basically, but never broke below it. We never broke below the 0 line here on the momentum indicator, and we never went below the 200-week moving average, even though we did, and this is a monthly chart, by the way, so even though it did trade below it, it never closed below it, even during COVID. So we are in a secular bull, and for that reason, the market can just continue going higher. In fact, it has a tendency to try to go higher. So that's what we're in. Never forget this. If you ever want to know where we're at or what the status of this looks like, just come back to this front page, the home page, and take a look at this every once in a while. It's a monthly chart, so it moves slowly. So maybe at the beginning of the month, see what it's done. But right now, we're actually above the trend line right here. But that doesn't mean we can't continue above it for quite a while. So that's where we are. Okay, the next thing I want to show you is the bias chart on the bias page, and we'll see what that looks like. Few more bullish ones flipped over today from bearish to bullish. There's a couple that went bearish also. like gold, like I mentioned before, right down here. So if I click on gold, we'll get the chart, and you can see right here, it just went short-term bearish. Now it's gotten close to that, but it never actually crossed the line, except for way back here, back in June, actually back in May. So it just crossed the line for the first time. So for those that are interested or in gold, that's something to pay attention to. You can see whenever any of these short-term signals um, trigger, you can see them happen. There's silver miners just happened today as well. Silver had already turned bearish, but the silver miners turned bearish today, and you can see right there, that's the short-term down signal. So just something to keep in mind. You can see it very quickly just by glancing at all of this. You can see up here we're starting to get more greens, and the market bias is starting to move up. Okay, so one more thing, I want to show the 10-minute charts, which are on the charts page, and just to give you a sense for what the market looked like for the week. So these are the weekly 10-minute chart. I'll start with the aggressive sectors. This is what the market looked like. You can see this vertical blue line right here is Monday's open. So we opened flat, we went up a little bit, and then the election and the whole market exploded higher. Pulled back a little bit today, which is to be expected on a Friday. Some traders want to go into the weekend flat, so they sold off. We'll see if that continues. Next week is options expiration, so it could have an effect on what the market does, especially as we get close to Friday. Here's the week before. So we blew through the week before as well this week. So let's look at the aggressive sectors. Here's technology. So if you'll notice the beginning of the week right here, this red dash line shows you where it started the week. And the percentages is the percent of makeup of the S&P. So technology makes up almost 33% of the S&P. It's the biggest sector out there. So it was higher for the week. Financials were higher for the week. Discretionary, higher for the week. Communication services, which is the internet stocks, actually was flat, started up, and then pulled back again today on Friday. Industrials was slightly higher for the week. And then if we look at the defensive sectors, this all is the same at the top. Defensive, healthcare started over here, ended down here. So healthcare was down, staples were down, energy was flat, utilities were down. I mentioned that utilities had a good day today. However, for the week, they're actually down. And materials as well are down. And this is where gold resides in the materials group. So all of the defensive sectors are down and all of the aggressive sectors are up. So that implies more upside. But I certainly expect the market to rest here pretty soon. Next thing I want to show you is also on the charts page. Every week, and I've updated some of this already for the week, but every week I put in the top and bottom performers of each of these industry groups. Last week, renewable energy was the #1 performer. This week, renewable energy is the bottom performer, the very last performer. And if we click on that, we'll see the chart. And there you can see what it looked like. You can see last week it was just trying. This is a weekly chart, by the way. So each of these bars represents 1 week. Last week I mentioned this, and it had a really nice rally. Looked like it was trying to go up, moving into the election, maybe implying that that Harris was going to win. And then this week just reversed and went down instead. The other one that I want to show you is on the top 10 is automobiles. So first we'll look at the chart for automobiles. And again, this is a weekly chart. And take a look at that. I mean, it's been heading higher. It's now broken through 2 resistant lines, and it's continuing to go up. It's got a lot of room to move still. If we go back here on each of these little bubbles, you can actually get the stocks that make up this industry group. So if I click on this bubble right here, what we see is Tesla right at the top. 8% up for today. If we look at the week, Tesla was up 29% on the week. Wasn't the best performer. Zoomcar, interestingly, was a better performer, but Tesla has done really well this week. Even GM and Ford are up. So that's one way, every week, these are for the week, not for the day, and it gets updated on Friday night. But every week you can see who the best performers were for the week, and you can just click on any one of these to get a sense for where the stocks are. If we look at soft drinks, for instance, Zevia actually had a great day, up 27%. But in general, these were underperformers, and Celsius was down 3.7%. So anyway, just wanted to point that out. Tesla had a great day. Tesla looks like it might actually continue to go higher. And with that, I want to jump to the daily scan. So first, we'll take a look at my worksheet. And by the way, for those that are subscribers, the worksheet is found on the portfolios page. If you go to the portfolios page, right down here, this is the total market index and the trend. But right here is the paper trade worksheet. So you just click on this button right here, and this right here, you need to be an annual subscriber. Won't work for monthly subscribers. And then you can download the spreadsheet that I'm going to show you right now. So this is what we have. I just added a new one. You can see that it's Raytheon in the defense sector that I pointed out before. But let's just quickly go through these and see how they've done. So we'll start with, and all of them are still in play. None of them got stopped out yet. So we'll start with DocuSign. DocuSign had a nice run today. I'm not moving the stop up at this point because it's moving up nicely. We want it to continue to do that. It reports on December the 5th. We'll make a decision just before earnings of what to do. Maybe sell half and let the rest ride. We'll see. But that one is looking really good. One of the reasons that it's a good point to get in when I do the scan, and hopefully you guys will start to see this, is it number one, it was on the top 10 list. That's the number one point of when you run scans like this, you want to run it against a quality set of stocks. However you determine to do that. These are the top 10 lists that I mentioned before. This gets updated every weekend. So the top 10 relative outperformers that need to outperform their own industry group by 10% or more, and they have to outperform the S&P by 5% or more. They have to reach both of those milestones. You can see ADMA is in here. The next one is the ones that have beat earnings and revenues. And the last one are the stocks that are in the IBD 50. And then down below are the large cap performers, the mid cap performers, and the small cap performers. I include all of these in this list. I update the list every week. You can see there are 240 stocks in it this week. I'm not sure what it will be for when I do it over the weekend, but that is a CSV file that you can download into any other platform. And that is the list that I use to run my scans. So they are already in the top 10. So you know already that they are strong stocks. So that's where I get the scans that we're going to look at here. So here's DocuSign. So remember, they're in the top 10, so they've been moving up. I want them to be pulling back somewhere near the 21-day moving average. And when they start to move away from the 21, that is the buy point. Two advantages of that. Number one, that's where they're just starting an uptrend. And number two, it allows you to put a stop very close to where that bottom was. So it reduces your risk substantially. So there's DocuSign. We'll just go through each of these. Here's Google. Google pulled back today. So bought it 2 days ago, pulled back today. It's an inside candle. So if it had gone below yesterday's open, that would not have been a good sign. But we'll see. It did it on lower volume, so that's good. Here's Oracle. Oracle moved up nicely today. Not moving the stop up at this point. I'm going to leave it right there at resistance and at the top of the gap. And what I'd like to see is, for all of these, I'd like to see them move up and then take a break, and that might happen next week, and pull back without taking the stop out, and then start to move up again. And when that happens, then I'll move the stop up to the bottom of wherever that uptrend will be. Powell, now I didn't get into Powell, so it's not on my actually purchase list, but it is on the worksheet. So that's where it hit the scan, and Powell is looking really good right now. Raytheon, this is the one that I showed you today. Got into it right there. Again, it has been on the top 10 list. In fact, if we go back over here, down here, you can see Oh, right. Oh, I know where it is. Raytheon probably will be on that list when I update it later today. But if I go to the market bias page, the bottom, we have the top 20 year-to-date gainers and losers for the S&P and the NASDAQ 100, and the top 20 year-to-date gainers and losers for the small and mid caps. And I just updated this tonight, and what I noticed was Raytheon right there, number 20, uh, in the S&P and NASDAQ. So it's not exactly 600, but between those two large cap groups, Raytheon was number 20. So that's a good sign. Um, so that's why I added this one today. You can see the stop right now is at 118. I'll look at that in a second. The next one was Sentinel. Sentinel pulled back a little bit, but actually ended the day near close to where it opened. So that's good. That's a bullish looking candle, even though it pulled back. Vertiv, we talked about, got into this 4 days ago, had a great, nice run today, continues to move higher. Again, I'm not moving the stop. I'm keeping it at the top of the gap and the resistance level. I like to see it move up and then pull back. And then when it starts to move up again without taking out the stop, then I'll move the stop up. So I'm just giving you a sense for how I like to do this. All right, so those are the stocks that are in that. Let's just quickly take a look at the watch list. And I have a comment to make on this one. We'll start with Affirm. Affirm, I talked about this the other day. This is where I put it on the list. You can see it just was going above the 21-day moving average. Didn't actually add it to the holdings list, though. It went up and had a nice run and then pulled back. They had okay earnings, but not great earnings. So that one pulled back a little bit. So maybe a good thing we didn't get into that, but we can continue to watch it. The next one is, let's go back to the list. Next one is Zeta. Now Zeta reported on, actually they report next week. So it's too close to earnings to get in at this point. But that's where it hit the scan right there. Pulled back some, and then it went through it again. So it hit the scan again, the second time on this one. And look at that. It's just really taken off since then. So Zeta actually looks pretty good. Now, the comment I want to make on this is going to happen. Sometimes I can't tell you whether it's worse to buy a stock and see it sell off, especially if I don't have a stop in place or I don't get out of it and it continues to sell off. I don't know if that feeling is worse or this feeling here where I saw the point to buy it and I didn't, and then it takes off. Sometimes it's actually worse to actually see it take off. But the thing I want to tell everyone is that is the way trading works. That is going to happen over and over again. If you have a quality list that you're working with, just like I said, that top 10 list that I use, number one, I know that there are more great names on there that are going to come up at some point in the future. So I don't have to worry about missing one or two. In fact, I'll look at the next one. And this is one that I actually talked about when it hit the scan right here. It was only 2 days before earnings. Now they blew away earnings. They had great earnings, up 46% today. But earnings are binary. You don't know if they're going to do that or not. So I don't necessarily like getting in. What I prefer to do is to get in somewhere back in here, and it would have hit the scan back here as well. That's plenty of time for earnings, and then it could have run up enough where if it reversed and started to go down, then my stop would be way down here. So I wouldn't really lose very much. But in this case, I'm not going to chase it. It could continue higher. I don't know, but that's the way it goes. That's just life. It's the way things happen. So those are the ones on the watch list. So now let's quickly take a look at the scans that hit the scans today. There weren't too many. I actually changed my scans a little bit to add in a line that says I want anything that has earnings more than 3 weeks away. So I'm no longer going to get the ones like this that are hitting the scan list just a few days before earnings. Instead, it's going to hit right back here in October. with a full month before earnings, and that's really what I prefer. So we'll take a look at the ones that hit today. There weren't too many actually. Okay, so here's one down. This is a downtrend reversal with an elder bar. I'll show you what it looks like. These are the stocks on this scan. What you'll notice is Raytheon is one of those, and Lockheed Martin is one of those. So why did I pick Raytheon instead of Lockheed Martin? Well, first off, Raytheon has consistently been in the top 10 list. It's been in the top 10 large cap stocks over and over. It wasn't last week, but I remember it because I update that list every week. I look if you just do nothing more than just look at the list and remember the stocks that are on there. So I knew that that was in the top 10. Lockheed Martin is a great company. If we look at the chart, you can see right here, they had earnings back here. Earnings were on 1022. So they had earnings right here, pulled back. They're starting to recover and move back up again, but it's not above the 21. It's not above the 50. The MACD is below zero, so that confirms a downtrend. The momentum indicators are just beginning to move up. The advanced decline line is down as well. So it's just beginning to recover, and it might continue to recover, but it still has some work to do. It's still in the cloud. It's still below the 50-day moving average. There's a lot of things that Lockheed still has to do. And down here, you can see that it's underperforming its peers as well, right down here. As opposed to Raytheon. Let's take a look at Raytheon. They're both in the same industry group, but Raytheon looks much better. So you can see how it's just been moving up. This is why it's been in the top 10, because it keeps hitting new highs. Raytheon had a great day today. It had earnings on the 22nd as well, the same as Lockheed. But the accumulation distribution, which is the pink line here, also came down during this downtrend. Now remember, I'm looking for strong stocks that have been in the top 10 that are in a downtrend and now have started to come back up above their 21-day. It's not yet above zero, but it's closer than Lockheed was. And the other indicators are looking like they're starting to move up. It's just above its cloud in this case and above its 50-day moving average. So that's the reason I chose Raytheon instead of Lockheed Martin. I just think that right now where it's at, it just looks like it's in better shape. It's actually outperforming its peers as well. This zero line basically is equal performance of the peers, the zero line down here. So it's outperforming its peers right now. Whereas Lockheed Martin, you can see, is right on the zero line. It's actually slightly underperforming its peers. So that's the reason I chose Raytheon in this case. That's the only one that I added this week. So we'll watch that. I put a stop at $118. And what's the reason for 118? Well, if we look at Raytheon right here, actually, I'll go and click on it because I've already updated the chart. So I'll click on it here and you can see that here's the day that we bought it and here's where the stop is. You can see it's right at the bottom of this pullback, just as it's starting to move higher. And that's what I meant when I said before, the nice thing about this is you can get them as they're starting to move back up after a pullback, but you can reduce your risk by putting the stop right down here where this bottom of this gap is. Also happens to be clear support. So it hit this multiple times. It was resistance over here, came up and hit it right there, couldn't get through, hit it right here multiple times, finally did go through. So that's what changes it from resistance to support. And then this proves that it's support because it kept hitting, and then moved up. So this is a great place to put the stop. It probably should set it a little below that area. In fact, I'm actually going to do that. And I'll tell you why here in a second. So I'm going to put this stop just below where that low was, which is going to be about 117 right there. So we'll put the stop at 117. And the reason is many times market makers can see, where people are putting, they're not looking at every single person. In fact, they're not looking at anybody's orders. They don't look at your orders and say, oh, they have a stop right there. I think I'll take them out. That's not what they do. They understand technical analysis just as well as we do. And they're looking at this. So the way that I um, think about it is, where are the orders? So they're looking at the same thing. They're looking at it hit resistance there and it broke through there and it hit support there and it hit support again. So they're saying, well, you know what? I'm gonna take them out. If it goes right back down to that level, maybe a little bit below it, then that's probably where a lot of the stop orders are. So if they get a lot of demand for Raytheon and they need to refill their warehouse, basically, they might let it come down right to that level right there, and then it will just fly right back up again. So that's the reason I put it right down there. In fact, I'm going to change my worksheet and I'll change this to 117. And you can see now it's 5%. If it does get down there, not too bad. And I used my risk calculator right here. Here's Raytheon. Here's the price, the entry price. Entry price actually was 123.23 was the actual entry price. And the stop now is at 117. So you can see right here, it tells me I can buy 50 shares. So that's what the risk calculator does. It limits your risk and tells you what your position size should be. Somebody asked me, where can they get the risk calculator? And I showed you that this worksheet is right on the website for annual subscribers. So you can get not only the worksheet, but the risk calculator as well, which frankly, I think is more than worth the cost of the subscription. Just this by itself is worth it. All right, so that's where we are with Raytheon just being added. Nothing's been stopped out yet. We're halfway through filling up our list. Next week, if we do get max pain next week and the market starts moving down before expiration date, then some of these could stop out. But what I'd like to see is some of the ones that have moved up quite a bit move back down and then start back up so I can move my stops up. But we'll wait until next week for that. All right, so that's it for tonight. Thanks everyone for watching. Have a great weekend and good luck trading. Take care.